Hello everyone, welcome to a new episode of Technical Analysis Capsules. Today we will talk about Fibonacci retracement levels. The Fibonacci retracement is one of the tools that can be used in technical analysis to assist in the detection of key trading zones during times of trending markets. Retracement levels based on the Fibonacci sequence assess the current trend moves and provide a region that the upcoming corrective move may be able to reach. The end of a correction phase for a price that is moving in the opposite direction of the current trend can be projected with the help of this tool. These levels are also utilized by a significant number of traders as potential support and resistance levels. As a result, our objective as traders is to buy from short-term weakness in a market that is trending upwards, and our objective in a market that is trending downwards is to sell from short-term strength. We will therefore make use of the Fibonacci retracement in order to determine the final result of any reasonable corrective move. Okay, so we can write this impulsive move both up and down. So we have a lot of Fibonacci ratios, but we're going to use 23.6%, 38.2%, 50%, 61.8% retracement, and finally 78.6%. In general, the level that is the least significant is 23.6%. It's the levels of 38.2%, 50%, and 61.8% that are the most significant. Many traders use these ratios to determine support and resistance levels. There is a psychological reason for the 50% ratio, even though it is not a Fibonacci ratio. The retracement of 50% is effective in the financial market, and the retracement of 76% is the last retracement for this trend. Retracement ratios are used to assess corrective pullbacks by comparing previous trend movements. So, in an uptrending market, we made an impulsive move. This is our highest low, followed by our highest high. Once this higher high has been established, we can expect price to pull back into a corrective move or phase, resulting in a higher low. So once we see price pulling back, we'll use Fibonacci retracement to isolate a potential level at which this corrective move could end. We'll plot our Fibonacci retracement tool from point A, the beginning of the impulsive move, to point B, the end of the impulsive move, and our ratios will appear. So this will be our pullback zone where we will wait for the corrective move to end, which could be 38.2%, 50%, 618, or 78.6% retracement. We don't know where the corrective move could end, which is why we still need to wait for confirmation, okay? So in a downtrending market, is there an impulsive move to the downside, lower high, lower low? Once our lower low is established, we can expect price to pull back into a corrective move, resulting in a lower high. Again, as traders, our goal in a downtrending market is to buy or sell based on short-term strength. So this is where we'll apply Fibonacci retracement. When we see price pulling back, we will plot it from point A, the starting move of our impulsive move or our lower high, to point B, the end of the corrective move or our lower low. Alright, then the Fibonacci ratio will appear. In terms of Fibonacci retracement, this is our pullback or trading zone. Once more, we don't know where this pullback or a corrective move will end. So we'll wait for confirmation. Alright, so how do you input the Fibonacci retracement ratio? So I believe most charting or trading platforms include a Fibonacci retracement tool. When you see your Fibonacci retracement tool, you can adjust the ratios so that we have 0 and blue one. These are our anchor points, 0 and 1. For 38.2%, we'll use 0.3824 or 50%, 0.54618%, 0.618, and 470, 8.6%, 2.786. Alright, here's how to use the Fibonacci retracement tool. Okay, so I'm using TradingView as my charting platform. And if you're using TradingView, you'll see the Fibonacci retracement tool on the left side of your screen. So on the third row, simply hover your mouse and click the tiny right arrow right, and the drop-down menu will appear, from which you can select the Fibonacci retracement. So for our ratio, 0 and 1 are our anchor points. 38.2, 50%, 608, and 78.6%. Now, I do not personally use 23.6%. However, you are free to use it as you see fit. So we'll look at the USD JPY daily time frame. So as you can see, we are in a downtrending market, but when price established a support, it impulsively moved up, breaking the previous lower high and making a new high. So we have more high. Now that we have a higher high, we can wait for price to enter a corrective move to establish a higher low in anticipation of another upward move because of the structural change. So we're expecting a price reversal. And since this is an impulsive move to the upside, we're going to use Fibonacci retracement to project where this higher low will be established. We'll wait for a pullback. Now, when we see a clear pullback, we are on the right track. So from higher high to higher low, we'll use the Fibonacci retracement tool. We'll start with point A and plot our fib. So where the impulsive move began, point B, where the impulsive move is, and all right, our ratio will appear. Again, we don't know where the corrective move will end. We just must wait for a confirmation to go short, which could end here, 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 or even here. Okay, so one way to confirm that we can wait is to look for a candlestick rejection, price action pattern, or continuation pattern. So let us move forward. As you can see, price is currently at 38.2% and has printed a load test reversal candlestick. So if you're a candlestick trader, you can definitely trade this right now with your stop loss set here. And yes, that's a move. Okay, so let's see what happens here. So price moved down, testing this 50%. So basically 38%, 30.2% did not hold. We are currently testing 50%. At this moment, the price is attempting to move away from the 50% support level. There is also a continuation pattern that we are forming, which can be seen by considering this action as a bull flag. On the other hand, if you are a price action pattern trader, you and I can wait for breakout if we want to trade this pattern, right? Therefore, price, and then there is our breakthrough. Is that correct? It is now possible for us to consider this a breakout, after which we can place our invalidation right here, right? And then proceed to ride the move, all right? As a result, 38.2% of the people did not hold we, and we were rejected at 50%. Do you agree? This bull flag was formed by the price at that point, all right? All right, let's see what transpired after that. Due to the fact that the price moved upward and broke this previous higher high, we were able to establish a new higher high. As a result, the price continues to rise. Therefore, if you did not trade this initial move, then we can still wait for the price to pull back because it has reached the higher high. And then we can wait for the subsequent corrective move to come to an end, which is fine. Consequently, the price maintains its upward trend, and then it began to pull back, which is fine. As a result, what we can do in this situation is plot our Fibonacci retracement tool from point A to point B and then wait for a rejection at either 30.2, 50, 6,118 or 78.6%. Okay, let's go. Therefore, as you can see, the price has just broken through the 38.2% retracement and 50% is currently holding. After that, the price began to move upward, breaking the previous higher high, which indicates that the 38.2% retracement was not successful. The level at which this price is rejected is 50%. Also, when we look to the left, we can see that this 50% retracement level is located after the C resistance level that was previously okay. Therefore, if you did not enter at this time during this rejection, because we are currently in an uptrending market, we can still wait for a pullback in anticipation of the next upside move, which is an impulsive move to the upside, and the price will now begin to pull back again. It is necessary for us to plot our Fibonacci retracement. The next step is to wait for a confirmation in this trading zone after traveling from point A to point B. Not a problem. Let us look at one more illustration. We are looking at a time frame of 15 minutes in GBP USD. As you can see, we are currently in a bearish market that is moving in a downward direction, which causes prices to move down suddenly, followed by a very obvious corrective moves. First things first, let's take a look at the possible outcomes of this corrective action. The Fibonacci retracement tool is going to be utilized again this time. As you can see, the price did not hold 38.2% and then rejected the 50% retracement, which means that this 50% retracement served as a support. Since this is our impulsive move to the downside from this point, we are going to plot our Fibonacci sequence. So point A point is going to be here. Okay, therefore the price has also formed a consolidation pattern, which looks like a bearish flag pattern. Once we observe that the price has broken through this bear flag, we could consider this as a confirmation that this downward move can continue. Again, 30.2% did not hold, and then the price began to move downwards. I hope that this quick illustration was helpful for you to understand the importance of the Fibonacci retracement levels and how can you use them beside other momentum and volume indicator to have better entries and exits for your trades.